Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, October 6th, 2023. We'll start with our executive summary. So, number one, today's jobs report was solid in that it supported both the resilient U.S. economy and immaculate disinflation themes, contributing to the trending transitory Goldilocks vibe in asset equity and credit markets. Private sector employment growth slowed to an at-trend 3-month SAR pace of 1.5%. Private sector average hourly earnings growth slowed to a slightly below trend 3-month SAR pace of 3.3%, which was the lowest since March of 2021. And the private sector average weekly hours was unchanged at a 3-month SAR pace of 0.0%. When you productize all these things on a frequency adjusted basis, we wind up with private sector labor income, which is the total amount of income we receive as consumers from the labor market. That slowed to a slightly below trend 3-month SAR pace of 4.9%, which is a 3-month low. Number two, as long as the top-down market regime is in a risk-off condition, investors should anticipate A, more bad news than good news, B, asset markets to generally respond poorly to bad news, and C, defensive dispersion within and across asset markets as a result of A and B. And then number three, we have PPI next Wednesday, CPI next Thursday. Next week, we remain of the view that immaculate disinflation is long in the tooth and sticky inflation will soon overtake that phenomenon as a consensus market narrative. Beyond next week, we have the September retail sales data on the 17th, the September PCE report on the 27th, the Q3 employment cost index on the 31st, and the BOJ meeting on the 31st as well. Each of these catalysts have the potential to perpetuate financial market volatility via threatening the resilient U.S. economy theme or advancing the sticky inflation theme. So we'll transition to my Bloomberg here this morning. We'll do cross asset performance. So stocks are, rising on the heels of this, solid jobs report. Again, supporting the resilient U.S. economy theme, supporting immaculate disinflation. That is positive for asset markets. So we got the S&P rallying today, but it's still down 0.6% on a week-over-week basis. Leading the charge higher on a week-over-week basis is tech at up 1.4%. Consumer services up 0.7%, and healthcare up 0.3%. And then the laggards here, we got energy still down 6%, utilities down about 5%. Transitioning to factor performance, yet as I mentioned, S&P down 0.6% week over week. You got very positive factor performance out of growth here, up 0.8%. You got what's lagging downside value, lagging substantially, minus 2.5%. In our opinion, this is very much the market starting to shift to a growth decelerating playbook in terms of shedding value in favor of growth and getting rid of low beta or high beta as well. High beta down 2.2%. Geographic performance, fairly dispersed. S&P up or down 0.6%. You got India leading to the upside, up 0.4% week over week. Brazil leading to the downside at minus 5.8% on a week over week basis. You also have Japan flagging at down 3% as well. Fixed income performance. Barclays, the core ag is minus 1.5% week over week. TLT is just getting tattooed still at minus 4.3% week over week. A lot of folks are really long bonds and have had a lot of really bad outcomes in their portfolio for not, just either paying attention to our research, hearing us when we said 60-30-10 is the new wave. 60-40 is dead. If you do not believe that, please check out our macro scouting report this afternoon. We would definitely be updating our fourth-turning analysis, our secular inflation models, and some of the key supply and demand factors analysis that we published on the Treasury market supply demand dynamics. And it's not good. It's just not good. And what we're seeing on our screens is happening faster than even I would have thought. And we've been among the biggest bond bears on global Wall Street for months now. And so this is, in our opinion, this is something that could get out of hand. We don't want to mince words about that. It's obviously not getting out of hand today. It's getting some reprieve today from the jobs report. But by and large, this is, again, something we're very much paying attention to as we head into the fall. Currency performance. Minus or plus 0.3% week over week. The dollar here, besting all currencies. Leading the downside is a Canadian dollar at minus 1.2%, Australian dollar at minus 1%. Commodity still flagging week over week. You got the broad commodity basket, the DBC, minus 4.2% on a week over week basis. You got uranium down 3.7%. You also got base metals down 4.1%, and then leading the charge to the downside, crude oil at minus 0.4, or sorry, minus 8.4%. This means it's been a total bloodbath in energy, which has been positive at the margins for kind of arresting some of the inflationary impulse that we've seen in recent months. But this is something that, in our opinion, we did a lot of work on that in our October macro scouting report as well, in terms of potential for an energy crisis. So definitely stay tuned to that if that's something that's on your radar or you're keenly interested in as an investor. And then lastly, crypto. Bitcoin up 3%, leading all cryptocurrencies on a week-over-week basis. You got things like Solana, which had been really outperforming, leading to the downside, as well as Binance Coin at minus 2.7 and minus 2.9%, respectively. And then lastly, transitioning to my Lombo dashboard. Not much to call out from the perspective of the trading ranges, with the exception of our friend crude oil here. Again, this is, if you believe in the bullish energy story, or you think, just the bare minimum as a portfolio hedge to your equity and fixed income exposure, this is a fantastic setup to be buying crude oil. You got bullish medium-term price momentum. It's had a significant bloodbath, a retracement of this move. It's now oversold. And so ultimately, this is a good opportunity if you believe in that. Again, believe in it as a core theme, or believe in it as a hedge. In our opinion, it makes a decent amount of sense, the bare minimum, as a discretionary investor, to snap up some energy exposure here. So we'll wrap up there. Darius Dale presenting our macro minute for Friday, October 6th, 2023. Join us this afternoon for our macro scouting report for the month of October. It's going to be a very big action-packed presentation. So looking forward to presenting that and unpacking that with our Pro to Pro subscribers in the coming weeks. So with that, wrap it up. Cheers. Have a great weekend.